Hey guys, what's up everybody? Happy Thursday this week. October has finally come. We're coming up on Halloween 2016. It's crazy how time flies. Well, anyway, I wanted to catch up today primarily on bonds. So bonds have been very interesting over the last several years. And so what I have up for you today is we're going to be talking about the 10-year Treasury bond. So the 10-year is interesting because it's half of the yield curve, right? So the most common measure of the yield curve is the 10-year and the 2-year. So if the 10-year or if the 2-year rate gets higher than the 10-year rate, then we call that an inverted yield curve. If they're close to each other, you call that a flat yield curve. And we know that the yield curve has been flattening at least over the summer. But recently, we've seen a little increase in rates. So what I have up on your screen, on the top left-hand corner, is the IEF. So the IEF is the second most widely traded bond ETF out there. So TLT is what we usually talk about, what I usually talk about. It's the most heavily traded ETF that tracks bonds. But that's based on the 20-year. And I'll probably go back to that in a little bit, but first of all, I wanted to show you the 10-year because, so the IEF is right up here in your top left-hand corner. That's the 10-year bond. And in the bottom left-hand corner, we have the TYVIX, the TYVIX. So this is the volatility index of the 10-year bond. So this is similar to the VIX. So the VIX is the volatility index of the S&P 500. It's based on options prices, and when options prices become expensive, then the VIX becomes expensive. So in your bottom right-hand corner, I have the S&P 500. In the top right-hand corner, I have the VIX. And you can see, so for example, in 2008, we had this big dip. Everybody started buying put options, and put options got really expensive. We got this really high spike in the VIX up to 90. Pretty incredible time that was. But the TYVIX, as you can see, also spiked in 2007, 2008. So you can see this huge spike here. Now the VIX will spike, or the TYVIX will spike when interest rate moves are expected. So basically, during that that financial crisis back in 2007, 2008, everybody expected a big change in rates to stimulate the economy. And if you look up here in your top left-hand corner, you got that. So rates went up quite a bit there. So part of this is bond buying. So everybody's fleeing from the stock market and going to bonds. So you can see this uptrend in the 10-year right here, as I have on your screen. You can see it on the shorter-term bonds. You can see it on the longer-term bonds as well. So now what does that mean for us today? Now let's take a look. I'm going to zoom in here. So let's do the dailies. The daily chart of the 10-year bond, the IEF. So here on the daily chart, and we'll go to the volatility index on the daily chart as well. So this is 1 year. This is the 1-year chart. So you can see that the IEF, the 10-year bond, has now reached the 200-day moving average. It's right on it. And in fact, if you look at the previous low right here, oh, that's not going to work. If you look at the previous low, let me zoom out here. Okay, the previous low right here, the bottom was 111.44. Today, 110.44. Today we are at 110.48. So we're basically right on that level. The low today was 110.46. So if we're going to hold this level, today would be the day. If you look at the volatility index of the 10-year down below, it's very low. So nobody's expecting really a change in rates. So people are expecting, at least people aren't buying options looking for a big move in rates. And a big move in rates at this time would be upward, right? Because rates are pretty low. We could see a rate move downwards, but I think everybody's anxiety is to a rate rise. So everybody's wondering if the Fed is going to raise rates, right? But if you look at the overall trend of the 10-year right here, this is a downtrend. So actually rates have been rising on their own. And you can see the downtrend here in the TYVIX as well. And it seems like people are getting more comfortable with rates about where they are. So here's the thing about the TYVIX, is this could be either direction. So at least that's what the creators say. So if you have a elevated TYVIX like here, when it was all the way up to 7.65, that shows that people were expecting some sort of a rate change, whether that was increase or decrease. The VIX itself, the actual VIX that's based on the S&P 500, is often referred to as the fear index. So that's based on put options. So generally you get a lot more volatility on the way down for stocks. But the TYVIX, according to its creators, does not have directionality. So it says that if the TYVIX is high, the market is anticipating, based on options prices, that options will move in one direction or the other. So since the TYVIX right now is quite low, down less than 5, in fact a couple of days ago it was down below 4.5, that means people are not expecting a change in interest rates in either direction. So if we look at our IEF, basically the bottom line is we may see some support in this region at the 1044 region and may end up moving up back up to the 112.5 region or so. Now one thing I did want to show you is the TLT. So this is, like I said, more commonly traded than the IEF, but this is based on the 20-year Treasury bond. So if we zoom in here on the last couple months, we see that we're at the same thing. So we are also at this level of support. So we're not quite at the very bottom. We've got a few cents to go till we hit the actual bottom that we did in September. And at the same time, we're not right on the 200-day moving average like we were with the IEF. So for me, what I'm looking for is maybe another day or two of down action, get us closer to the 200-day moving average, get us closer to the low from September, and then probably pull the trigger. And probably looking for a retracement back up to the 137.5 level. And what we might end up seeing is a decrease from this level. So we have this downtrending highs, right? So we have our high back in July, and then ever since then, the highs have been falling. So what I'd probably look for is a retracement up to around the 137 range, somewhere around here, to try to continue this trend downwards. And then at some point, maybe a breakout below this 200-day moving average. But I'm not so sure that's going to happen today or tomorrow or on this time. I think we may probably get one chance back up here and then maybe move down that way. But it's hard to say, of course. If we look at the volume isn't giving us a whole lot of clues here. We do know that there was a lot of down volume on this most recent downtick or down, you know, medium term trend, the swing, which may point to some strength there. So that may help us determine that when we do retrace upwards, that we will retrace back down again. Also, there's a little divergence here in the MACDs. So you see this is September low is at that level. Right now we're a little higher than that. So there's a little divergence there. So that kind of points to this pattern where we move up first to maybe around there, and then we have to reevaluate at that time to see if maybe we do take this downtrend farther. If rates do continue to increase like they have this past week, and then eventually bring the price of bonds down. As you know, the price of bonds falls with increasing interest rates. And that kind of makes sense, right? So if you've been following the news, you know, Europe is talking about whether their economy has strengthened enough to decrease some of the central bank support in Europe, in which case we would probably follow suit as well. So if our economy is doing well enough that we can raise rates in December like they're planning, and possibly more in 2017, then this all makes sense, right? Then bond prices should fall because interest rates would increase. All right. So I thought that was very interesting. Hope that helps you. And hope I was able to teach you something about the TYVIX, the TYVIX. We'll see how truly useful it is. I know a lot of people use the regular VIX. I know not as many people use the TYVIX. But it's definitely out there for you to take a look at. All right. Well, anyway, enjoy Thursday Night Football tonight and your Friday tomorrow. We'll see what shapes up next week. All right. Have a good one. Bye-bye.